Welcome to Ossiam Clients. This is Robert Shiller. I'm here so that we can discuss the CAPE ratio, the application of it to sector rotation strategies, and just general questions about long-term investing strategy. So let's get to the questions. I developed the cyclically adjusted price-earnings ratio with my former student John Campbell in the late 1980s. We did a different price-earnings ratio, real price divided by a 10-year average of real earnings. The point is that earnings can be volatile from year to year. It works much better to look at, as an indicator of valuation, look at price relative to a long average of earnings. We showed that historically this ratio predicts long-term returns somewhat well. The idea is that earnings were generated by accountants with the express purpose of indicating the fundamental success or value of a company. As an investor, you want to buy undervalued companies. So the conventional price-earnings ratio, which typically uses a one-year earnings, helps, and it's shown to have been an investment strategy that on average has worked. But it can work even better for indexes if you take a longer average of earnings. It just represents the sense that earnings are somewhat volatile. We just have to smooth more. We find that the CAPE ratio predicts longer-term returns better than short-term returns. This is key to value investing. When valuation is high, it's a bad sign for returns in the future, but it doesn't mean that it's going to turn next week or next month. So value investing is for patient investors who recognize that the ultimate idea is to buy low price relative to fundamental value, but don't expect that to work quickly. I've been working for some years now with people at Barclays Bank to develop an index or a method of sector rotation using CAPE. What we do is we start out with 10 sectors and compute CAPE for all of them. We do an adjustment for relative CAPE so that we don't over-focus on sectors that have always had low CAPE. And then we pick the lowest relative CAPE sectors, the 5 lowest. One more step is to drop one of them which has the worst momentum over the last year. And there we have an index. Well, one thing that we do is we have a momentum correction. One problem with value investing is that you may, picking low-priced stocks, you may pick up stocks that have suddenly started to crash because something is fundamentally wrong. So we eliminate, among our 5 CAPE sectors, one that shows the most value trap vulnerability based on recent momentum. Accounting is a venerable profession that had seen many adjustments over the years to accounting standards, and now there's multiple concepts of earning. Ultimately, I think that accountants, when they make changes, are doing them for a good reason. Often the nature of risks and the issues that make it difficult to measure earnings are changing through time. So we take it as a product from the accounting profession. Now we can choose among different earnings measures. We use reported earnings, which is the standard bottom line. You can try other measures, and there's been some controversy about this. But I think you'll find that the CAPE ratio computed with the other measures is often fairly similar anyway. So we're sticking with the traditional, but it's not really traditional because the definition of reported earnings changes with the times. But we also make a correction for relative CAPE. so that if there is any drift in the general level of the price-earnings ratio because of accounting changes, that will gradually be corrected for. There has been a downtrend over the last century, in the payout ratio of dividends over earnings. That kind of trend will affect the growth rate of earnings through time, and it will affect the 10-year average of earnings. So to eliminate that effect, in my work with people at Barclays Bank, we have used a CAPE ratio based on a total return index and earnings for a total return index, which eliminates the effects of the change in the payout ratio. There's been a revolution in finance in the last 20, 30 years, bringing us away from an excessive reliance on the efficient markets theory and recognizing that markets are populated by real people, and recognizing that some thoughts about psychology, which have never completely disappeared, but now we're recognizing that it's important to think about human psychology. And I think that the CAPE ratio that is part of this behavioral finance revolution, because it's the thinking of investor psychology that leads you to think that some stocks might be undervalued, they might be ignored, there might be a sensible reason to try to lean away from the crowd, to be contrarian. The question is, how do you do that? And then we have to read and think expansively about what we've learned about human behavior and what we can learn from the data in financial markets.